Yo, 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 what is up? How y'all doing this Friday? This is Antwaiyn Small's Financial Blueprint. We are back for another stock market live. This time, though, we are on live on YouTube and Facebook. So I want to, put out that from now on, when we go live, when it comes to this stock market live, we will be on YouTube as well as live streaming on Facebook as we continue to build and progress this channel in a positive direction as we continue to pour into you when it comes to all things stock market. I love you guys and I appreciate you. Continue to, support, continue to invest, continue to, tap in with me. If you like the content, please hit the like button. Remember, hit the like button, subscribe to the channel. If you on Facebook, hit the like button, leave me a comment. We're going to talk about all things stock market today. And we have a bunch of different topics to discuss. If you are on YouTube, please hit the like button, leave me a comment, as well as subscribe to the channel. All right. So if you've been with me, over the last couple months, right, we've done this stock market live every week, usually on a Thursday or Friday. Thinking about switching to Fridays as we continue to review what the stock market has to offer us and where we need to be looking at when it comes to our investments. So let's go this week as we have seen some volatility. All right, there has been a lot of things going on. As we know, seasonally, September and October are pretty volatile, but we did have, an unusual September to where we didn't really see a big pullback. But we are now currently looking at some pullbacks that we have, had over the last 2 weeks, right? That has something to do with the government shutdown, and not the shutdown specifically, but the impacts of what the shutdown then provides when it comes to the market as a whole, which is uncertainty. The longer the shutdown continues, the longer that we don't get certain, programs. We have issues when it comes to federal funding and a lot of different things. Military possibly not getting paid in the next couple weeks. We've seen a lot of turmoil across the macroeconomics with trade and China. There's a bunch of different reasons why the market's been not operating in the way it's been operating, this year. So as we continue this week, we need to understand why. We need to understand how to invest and ultimately what opportunities is out there, right? So right now we're going to take a look at the charts as we look at the S&P 500 this week or over the last couple of months. And as you can see from the screen, that right here on this top right corner, we are seeing some volatility, right? We see the green lines is going up. This is charting. This is technicals. We're not bringing too many technicals into the spotlight currently, but if you can pay attention, red is obviously means the market's going down, and green means the market's going up. And again, this is the total stock market S&P 500 index, right? SPY. So whenever I'm taking a look at the total stock market, I go to SPY and I put the charts up just to look at where we currently are in the market. And I try to see, as a whole, what's going on. All right. So if I bring this into a 1 month chart, all right, so more of a magnifying glass, I can see that. Let's look at these two lines. This is 75-day moving average, which is the yellow line. And I have the 200-day moving average. So as you can see, over the last 30 days, there has been some choppiness when it comes to the stock market. We've seen a big drawdown. They come back up, another big drawdown, rising back up, drawdown, which we had this week. And then over the last 24 hours, we've seen a little bit of a recovery. So the last 5 days, again, a lot of choppiness. The opportunities are there when you see these dips down. Definitely take advantage of those opportunities on those days. You see those dips down. There's our buying days for sure when it comes to long-term investing. It's important that you understand, when to buy things, not necessarily just what to buy, but also when to buy. So that's just a quick overview of where we currently are in the stock market and, possibly what we will see in the near future. So where we are currently right now, the stock market has had a lot of volatility over the last 5 days for different reasons. And as an investor, what we want to do more than anything is understand what to buy and when to buy. But before we get there, let's understand this. You can't get scared of investing. You have to be very even keel when it comes to your emotions. The media a lot of times will drive fear, right? Because it's a way for people to sell their stocks. As if there's a lot of fear in the market, people tend to just, panic, right? Sell, 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 which then because you don't want to lose money. So you feel like you just want to sell stocks because of that reason. When in reality, we know just by, we did the show a couple of days ago where we talked about the beginner level when it comes to investing in the stock market, is that on average, the stock market goes up 8 to 12% a year, regardless. Right. Regardless, the stock market goes up 8 to 12% on average over the last 75 years. On average, the stock market goes up 8 to 12%. So if you know that, then these drawdowns are not times to sell. The drawdowns are time to buy. It's always the opposite from a psychological perspective. When you see blood in the streets, not blood literally, but obviously red in the market, you have to look at those opportunities and take advantage of them. All right, we're going to talk about Bitcoin in a little bit, as we've seen a huge drawdown in Bitcoin over the last 24 hours. And we took that obviously as a buying opportunity today. But always understand that opportunities show themselves in the red, in the drawdowns, and if you're looking at a chart, seeing what those averages are and ultimately taking advantage of the times when they come down. So let's discuss how a correction in the market could possibly be a good thing, right? This is the one analyst. She's stating that a correction is not bad for the stock market as a whole.
Carrie Firestone, co-founder, chair emerita of RS Asset Management, as well as a CNBC contributor. Been kind of calm when you've been on recently. Is your calm being shaken at all at this point, or no? You see any troubling signs? Anything percolating up? Any canaries dying anywhere?
Well, there's always the possibility, and we've seen action in the market, particularly at the end of the weeks, that would be a little more concerning. But if we consider what's happened over the last 2.5 years, for sure, we have up 12% this year, and we've been up 25, 26% in the last 2 years. I think it's time perhaps for a correction. Corrections happen to markets. We forget about it because it seems so unlikely over the last several years. But if the market were to go down 5 to 10% with the valuations we have, I don't think that would be out of line, and it would be healthy for markets. I mean, markets need to have some resets, and this market has gone straight up. A week ago, we were just talking about, or 10 days ago, new high, new high, new high, new high. How many new highs have we had this year? So to have a little bit of a correction and show that there's some realistic behavior by markets would be a sensible thing, not an irrational thing.
So what she is basically saying is that the normal stock market doesn't just always go up like a straight line, right? Because of different factors over the last 2 years, we've seen the stock market soar, right? Consistently over 10, 11 months, with stock market just up and up and up. And what we've seen over the last 2 months is new high, new high, new high, just stocks hitting new highs every other day. S&P 500 hitting new highs every other day. What she's saying is that's not a normal thing, right? If the market only goes up 8 to 12% annually on average over the last 75 years, then we know that it's not a straight line up like an elevator. There's usually some dips, some corrections, some cooling off phases, things like that. And what we've seen right now is the market has just been going up all year since April, since the Trump situation with China and tariffs across the world. We've seen the markets go crazy, and it's been a great time to invest in the stock market over the last 6 months or so. But there is usually some type of corrections, some type of cool down phases. And ultimately, it's not a bad thing from the standpoint that as an investor, I also want opportunities to get into stocks at a discount. So if we always are going up, then a lot of times we don't necessarily get to get in. So looking at this from a positive perspective and from an opportunity perspective, 5 to 10% dip in the stock market is not going to really do much. But it will provide some opportunities if you are a new investor or if you're trying to get into some more shares of stocks. It's a great opportunity to continue to buy.
There are pockets of troublesome speculation. And what do you off camera called it, like what, rolling?
I call it rolling bubbles. Rolling bubbles.
Which is better than roiling bubbles, I
Yeah,
suppose.
definitely
Rolling
better.
bubbles can turn into roiling bubbles, probably.
Right. Well, they could. But remember, in 2021, we had meme stocks. You guys were talking about NFTs every day, talking about a roaring kitty all the time. I mean, forget about those. Now, they didn't have huge impacts on the market, but those were bubbles. AMC was 65. I mean, I love Adam Aaron, a friend of mine, but stocks 2 and GameStop 120, and it's 20 or something like that. So you can see these stocks in the AI space that have been up on just enormous moves, up 30% in
But AI is such a bigger part of
the
the market.
phenomenon is the same, but it's got to be it's
the amount of
logarithmic, exponentially.
Okay, but
probably 10 to the third in the top.
If that's a bubble and it
how
pops,
much money
it's
we're
be
talking,
a lot more pain.
and just how much money we're talking about that's involved.
Correct. But the companies behind it, if you look at Google, Meta, Apple, Microsoft, these are the biggest companies in the world.
They're
biggest revenues, biggest profitability. They're bigger than industries. They're bigger than.
And they have real
countries.
businesses,
They have
unlike
huge
some of the. I mean, AMC does too, but it's.
But it's not like those companies are going to disappear or yank their funding entirely. But even if they were to say, hey, we're going to cut our spending, our CapEx spending by 10% next year on AI, that would probably have a pretty significant impact.
It would have an impact mostly on chips.
Right.
And remember, until 2025, everybody thought of chip stocks as cyclical.
Right.
They used to have cyclicality. It wasn't because they wanted the cyclicality. It was because the people who ordered from there, their customers, said, we're going to cut that order or postpone it or defer it. That's what the chip business was about. It was about the buyers saying, we don't need all those chips that we've ordered from you over the next,
So
10
is that
years.
not going to happen anymore because there's so much demand for AI compute power?
I think it's likely to happen to some extent. We have no idea what these hundreds of billions of dollars of chip purchases are going to do. And if Google finds in 2 years that they're not getting any return from the investment, I think that they could scale it back, but that doesn't mean it's the end of chips. It means that there'll be a 20%, 30% correction in the stocks. We saw that last year with NVIDIA. The stock was down over 30%, and then it came back to an all-time high. This has been the case. When I say rolling, these bubbles or cuts or corrections come back very fast.
We were up 36% or whatever since the April lows.
Yeah.
But you are seeing things like, suddenly the 10 years, maybe it's because they're round numbers and we talk about them a lot. 10 years suddenly is under, 4%. Oil is firmly below 60 right now. Gold goes up every day and it's at an all-time high.
Yeah.
Bitcoin, these things, Bitcoin's not supposed to be correlated, but it is correlated with
Sure.
It makes sense that it's down, I guess, since it's a risk.
We're going to discuss Bitcoin in a little bit. And as you can see right here, Bitcoin it dropped down to 104,000, right? From, I think the high is 123 or 124,000. So it's come down significantly over the last 24 hours. But I want to harp on what they're talking about when it comes to this interest rate situation, right? So when you see the short-term and long-term treasury yield percentages, right? The 10-year is really what you really want to look at, is because this 10-year is something that when it comes to someone like myself that looks at real estate, is looking at buying a house, that's looking at buying another house or a real estate property, the mortgage rate follows this 10-year treasury yield. It's not correlated directly to 3.9, but if it correlates to about 2 I would say 2.5% higher than this number right here. So if you're looking at what interest rates are when it comes to mortgage rates, you can really, add a two onto this, and maybe a little bit more, and mortgage rates is going to align with where that 10-year treasury yield is. One other thing that you need to pay attention to is when it comes to the 2-year and the 5-year, when you're looking at high yield savings accounts, right? So you want to make sure that your high yield savings account yield that you receive on that high yield savings account is higher than the rate of inflation, right? So a lot of times the high yield savings accounts will follow those treasury rates to make sure that it is above or at least aligned with those percentages. So there are different, things or reasons why the 10-year and the long 30-year treasury is important. So understand that stocks do well in a lower interest rate environment. Stocks do well in a lower interest rate environment. So the lower the rates are, the better stocks will do ultimately in that environment, right? Stocks don't like high rates. Banks, businesses, etc., doing business in a high rate environment is difficult. So it's a good thing to see the treasury yields come down. That's a positive thing. All right. So just take a look at that as something that a lot of people don't understand when it comes to interest rates and how those things correlate with a lot of different factors of our economy. But it's important to pay attention to the interest rates and know exactly where they are going, either up or down, when it comes to your investments, either in stocks or as well in real estate.
Bitcoin's not supposed to be correlated, but it is correlated with
Sure.
It makes sense that it's down, I guess, since it's a risk.
Well, it's a speculative asset.
A speculative asset, but all these other, do any of these things, do they portend something more than 10%, or in a market which really hasn't been embraced that much? I don't think maybe 10% would do it. I mean, people are already worried, already talking about bubbles.
Well, people are worried about any drop in valuations at all.
The weekends might be selling right now, theoretically, or not.
Yeah, it feels to me as if the market is primed for something over the next few months that's going to be a decline.
And not 20.
I don't see the 20 because the earnings, GDP is good, interest rates are coming down, and also
right, interest rates.
Yeah, interest rates are coming down. And remember, we're in an environment where if you are big, like the biggest companies, they're able to help their own problems go away, because they can structure a deal, they can create something with the government, whether it's NVIDIA on the revenue from China sales. If it's Google, it's a fee, it's $2 billion, and you don't have as much problems with antitrust. There is an ability for the largest companies who, again, control this market and in a way control the economy to solve their problems that did not exist 5 years ago.
Someone yesterday was talking about the fiscal and monetary juice that's coming. A lot of it from the one big beautiful bill with corporations. It's not just extending the 21% lower tax rate on corporations from 2017. There's a list of things that corporations got
Right.
in that bill in terms of 100% expensing and different tax rates, and none of these tax breaks have not hit yet. So there's going to be some fodder for expansion, and for, I guess, it could make its way into the market.
Let me just say this real quick. Do not wait and by thinking that the market is going to crash anytime soon. Do not wait to get into the stock market by thinking that the stock market's going to crash anytime soon. Right. A lot of times when you're listening to like analysts and news and stuff, they just say a lot of stuff because they have to put it out there. It's their job, to speak to the fact that there's a possibility that there's a 5 to 10% drawdown. There's always a possibility that the market's going to draw down, right? When it comes to, seasonal factors, volatility, our president, right? Different things, China, trade wars. It's a whole bunch of reasons why the stock market could draw down. So it's important for you to know there's a possibility of it happening. But what I don't want anyone to do is to get to a place where you're waiting. You need to put money into the market as much as you can on a consistent basis. What I always say is when you see red, you take advantage of those opportunities. Right? This week was an opportunity on I believe 2 days. The market drew down significantly to a place where it was like, okay, it's time to buy. Okay, it's time to buy again. And then today, Bitcoin, we're going to get into Bitcoin. It was time to buy Bitcoin today also. So investing is something that you have to do on a consistent basis, as we talked about in our previous video a couple of days ago in the beginner's guide to investing, right? Tap into the YouTube channel to see that video when it comes to the beginner's steps to start investing, right? Consistency, consistency, consistency. I'm not waiting for a 5 to 10% drawdown in the stock market. I'm always getting myself prepared for an opportunity. But when we see dips, when we see Nvidia in the 170s this week, oh, I bought more. When we seen the stock market come down to 652, I believe, oh, I bought an option. Already up 30%. Anytime you see drawdowns in the stock market, you have to take advantage of those opportunities. Do not sit on the side waiting for the market to crash. Even when it comes to real estate, do not sit on the side thinking the real estate market is going to crash. It's not. It's not. Not anytime soon. Buy real estate, buy stocks as much as you possibly can. Buy assets and allow those assets to appreciate over a long period of time.
How much is in money markets right now?
A lot.
7 trillion?
Trillions, right? So the investment world understands that's coming. It's not just U.S. investors, it's foreign investors. They see that there are benefits for the corporations of this company and the public companies. As we know, the number of public companies has declined by 50% over the last few decades. And if you're a public company, it's a good place to be if you're going to have less regulations, because they have tons of regulations. That's why you're seeing more IPOs in part. IPOs, remember, they go from private to public. It used to be that private companies didn't want to go public because the whole idea of all of the filing and the rules. Now it's going to be less onerous. So I see that as a positive for public markets.
I mean, if there are things that we don't know about in the credit world that are, ready to rear their ugly head, isn't a declining interest rate environment, doesn't that take some of the stress off the things that could be, like as the tide comes down, no one's wearing a bathing suit? That's a Buffett quote, isn't it? Yeah. And if you've ever been to a new beach, everybody.
Well, tell us.
Everybody should. Well, no, everybody should wear a Everybody should wear a bathing suit.
Right. It's an ugly sight.
Don't you feel that if we have problems, and remember, we had First Republic disappear, Silicon Valley. Now, those were big. Those were a lot bigger than what we've seen right now. The market absorbed those. There was a way for the system to create a process by which those companies were, consumed by others. And that's within the financial mechanism of the United States. Now, I don't think it's impossible for a bank to fail, a regional bank. That's why these banks are going down to the extent that they are right now. There's fear. But I don't see that.
But you don't think those loose credit or situations extend to any of the bigger banks, the brokerages, anything along those lines? Because that's the question. Jamie Dimon brought up the question this week, where there's one cockroach, there's a lot more. Yeah. And that's the fear. Is there more off-balance sheet stuff that we don't know about? Have the general lending conditions not been as strict as they should have been, given what we've seen?
Yes, they've not been as strict. They've not been as tight. And I would imagine that there will be more problems, particularly in the private credit side, where we really haven't seen anything materialize. Yeah, the off-balance sheet stuff. There's so many private credit funds that the public has embraced. So it's likely that there'll be a problem. Can we absorb that? Is that going to cause
it's not systemic? It's not going to. The whole system is not going to be shaken, or is it?
Well, it might be shaken a little bit, but there's a lot of resilience in our systems. And
so if we've seen this happen before. We've seen this in 2006, that led to 2008. when it came to these regional banks, when it came to some of these, corporations that had loans out in real estate that wasn't, good loans, right? So there is always a possibility that banks do, bad things when it comes to approving loans that they probably shouldn't have approved. But as we know, the banks get bought out, or someone in the government comes and saves them with a bill, or there's a buyout. There's always a way that in this country that we save banks, or we allow someone to buy them, or we allow them to go bankrupt, and then somebody grabs them up. So there is really nothing to be worried about when it comes to that specifically. Now, if you're investing in regional banks, then that's a different conversation. But here on Financial Blueprint, we're not investing in regional banks. If we're going to invest in anything, we're going to invest in the best of the best. If you're investing in banks right now, hey, JPMorgan, Goldman Sachs. I mean, you could talk about Capital One and Citibank and things like that, but JPMorgan. There's really nothing. I mean, you can talk about. I mean, Berkshire Hathaway is not necessarily a bank, but they do a lot of different insurance and financial stuff. But JPMorgan, what we're going to do here is always talk about investing in the best companies. Let's stop with the trying to invest in the penny stocks. Let's stop trying to invest in companies that's ultimately regional local banks that ain't really got a balance sheet that's really going to help you long term. They can't sustain your portfolio over a 5, 10, 20-year span. How about we invest in great companies that ultimately lead the sector and lead the industry as a whole? That has an amazing CEO like Jamie Dimon, right? So if you are investing in any companies, anything, invest in the best companies in the world. If they ain't top 1, 2, or possibly if you want to reach to 3, if they in the top 1 or 2 companies in the sector, don't even have a conversation. It's not even, it's no point even having a discussion. That's how you can sustain a portfolio. That's how you can ensure that you are not going to ultimately lose money long term. Nothing is a guarantee, but you can put amazing companies in your portfolio to give yourself a good chance to not lose money in this market. All right. So how do we invest in this volatility? That's the question, right? What do I buy? How do I trade? What do I do? Right. Stock market goes up, it goes down, goes up, comes down. That's what we've seen over the last week is up and downs, right? It's really big drawdowns and then really large, up in the market. And then we got, Trump speaking, and then people getting, tight because they think the market's about to soar, and then it doesn't, and then it comes back down. And then it, what we did today was it drew down, and then it rose back up and finished pretty well. So what do we do in this current market is the question. And this is how we're going to trade, and ultimately how we're going to invest in this current market.
So do these moves in volatility and rates signal deeper concerns lurking beneath the surface? Guy,
I think they should. I mean, yields are going lower because it's a perceived flight to quality. We can probably all agree or disagree on that, but I think that's what's happening. But on a 40-point handle day lower in the VIX, on the S&P, understanding that from high to low, it probably reversed about 100 handles. There's no way the VIX should be at 25, in my opinion. So it is clearly trying to tell the market something. And this comes in the wake of last week's reversals that we talked about, some of the fundamental and technical damage it's done. And the fact that gold had the move that it had on a risk-off day is absolutely concerning. So, yes, I'll think this will be a day or a week or so that we'll come back to in the months to come and say, the market was trying to tell us all something.
Yeah, and I don't think it's about shutdown or tariff fears. I think the market has been pretty comfortable with that, right? So we had all that going on, and we had a VIX grind down to like the mid-teens or something prior to the tape bomb that we had on Friday. Obviously, we're going to talk about this regional banking thing. And, to be hyperbolic about this and what's going on, this is probably a bit too early. If we take a page out of the playbook from March of 2023, we kind of know there's going to be some support for this thing, right? They're going to kind of figure this out. Some of the numbers that we're hearing about for these smaller banks don't seem to be particularly large. They don't seem like there's going to be systemic sort of risk. And I think maybe it's too early to say that. I'm not a bank analyst or, look at these things pretty closely. But the only thing I'll say is that if we're about to lose a couple of these banks, and then it looks like further than May or March of 2023, I think we lost a bank in May of 23 after a few, then you have to say to yourself, what saved us back then? Yeah, there was a little bit of QT, but it was really the interest in this AI trade. And at this point, I don't think AI can save this sort of situation. And I don't mean to sound so dire, but look at the way these stocks traded. Look at the way it took down some of these large money center banks, especially after what we heard from them earlier in the week. So it just feels like investors are looking for reasons to kind of sell right here. But when you see the sort of pain that we saw on Friday and then here in other sectors, that should get your antennas up a little bit.
Yeah, I think you're right. People are looking for a reason to sell. I mean, the markets have done so well this year. At some point, you're going to see some profit taking. But I also think on the flip side, you are seeing these large amounts of cash that are sitting on the sidelines. And a lot of that is from institutional investors, just still left over from Q1 and Q2. They're hoping for some sort of 10% correction that they can buy on because they don't want to be sitting on this cash if markets keep going straight up. I think that's why you're seeing these up and down moves, because you're going to continue to see these dips bought. So I actually am not overly concerned about this. I do think you're going to see some profit taking here, but I don't think this is going to be longer lasting.
So I'll go back to yields. I think it is safe haven. I think it's about China, maybe a little bit about government shutdown, not much. Also, the Fed's going to be lowering rates. I think yields are probably getting ahead of that. And what else are they going to be doing? Ending QT. So I think the market's getting ahead of that as well. It's rarely that you see the 10-year below the Fed funds rate. And we see the 2-year really goes in lockstep, but it's rare that you see the 10-year below it. So that dropped as soon as they started to lower rates. We went from 4.25% in the Fed funds rate, and you saw the 10-year drop, and now it's below 4 or around 4. But the Fed funds rate is around 4.1. So I think this is all normal.
It's all normal. No biggie, huh, Guy? No big. I mean,
when it's the bond market, maybe it's normal. Fed can do what they want. I think rates are going lower because people are scared of something. And I think that's what the gold market's been saying for a while. I think it's this flight to perceived quality, which may or may not be the right thing to do. That time will tell with that one. I'll say this to Dan's point about the banks. If things were as robust as the market until today suggests, KRE should not be at levels we last saw in August, the all-time high being made 3 years or so ago. Think about that for a second. So if you have all this M&A activity, if the bank, if the
things are so great for the
is,
large money centers.
they should be better for the smaller
Exactly.
banks, and they're not.
So again, I'll repeat this again. Invest. Listen. If it's one thing you gonna see me say, or you gonna hear me say over and over again, is invest. Illinois. As I said on Tuesday, what is the 3 to 5 stocks you love? What are the 3 to 5 stocks you love? Invest in those 3 to 5 companies. Always pay attention to those 3 or 5 companies. When they draw down, buy more shares. Kill the noise. Kill the oh my God, the fear, the smoke and mirrors. All of the analysts telling you that there's a possibility of a stock market crash. You see bear market. I'm in comment section when I'm trading, and you just see it all over. Oh, the market's about to crash. The markets are going down. You see this all over YouTube. You see it all over, Twitter, etc. Right? So it's always everywhere. Anytime a little bit of red comes into the market, we just go crazy. Fear. Hey, listen, I'm telling you this right now. I love it. Bring the fear. Bring the red. Bring the drawdowns. I'm looking at the charts. I'm looking at support and resistance lines. I'm paying attention to when to buy. We're looking at opportunities to get discounted great companies at a discount and kill a bag, ultimately buying shares long term and ultimately trading options over a 6 to 12 to 15 month out span. That's it. And when you looking at options and you saying your account continuing to grow and you ain't doing nothing, but just sitting down looking at green and seeing amazing numbers come across your portfolio, none of that other stuff even matters, man. None of that stuff even matters. So always, always, always invest in the 3 to 5 great companies that you love. Pay attention to those drawdowns. Pay attention to those opportunities and buy more, right? And right now we're going to, have a quick little video where it speaks to what people are currently doing right now when it comes to, are they buying into the dips? I think so. Let's talk about it.
Let's get back to the broader market now. Investors perhaps brushing off some of the initial concerns around trade tensions with China. Certainly, all the major indices are still tracking for what would be the second positive week of the last 3. Joining us now with an outlook is Charles Schwab, head trading strategist Joe Mazzola. Joe, good to have you this morning. I guess I'd love to start you off on just some of the weakness we saw yesterday in terms of this sudden concern around credit quality and things of that nature at the banks. Whether you think that's going to continue or it's sort of a kind of a very short-term story.
Well, we're hoping it's short-term. If you look at the credit spreads, they haven't widened to show that there's real contagion concern at this point. So yeah, we're hoping that it stays within a few of those regional banks. Time will tell. But like I said, from the way that I'm analyzing it, at least in the credit curve, I'm not seeing that. And the equity markets are bouncing back today, not just as a whole, but specifically you're seeing that in the financial stocks. So I think that provides a little bit of a credence to that bounce. I think, the other thing to kind of pay attention to is just the equity inflows. They're continuing to make their way into the market, and there's a little bit of kind of an upside bias from what we've seen from the retail public.
Yeah, now I know you have views on both the retail and institutional flows, and they're somewhat different, aren't they, in terms of at least their approach right now?
Yeah, to be within a stone's throw of all-time highs and see the VIX at 24 is kind of shocking, and it just kind of gives it goes to show that institutions are hedging, institutions are really protecting some of that downside, while we're seeing a little bit more of that upside bias with the retail, not just from the equity inflows, but on the option side as well too. A couple things that I pay attention to would be like equity call buying. That tends to be more of a retail type trade. And when you're seeing that specifically in the technology, communication services, consumer discretionaries, the sectors where you tend to see the mega caps reside, showing that retail still believes that there's some more upside to this market. I don't know if I don't believe it's a FOMO trade just yet, but I think it's getting to the area where it's a little bit frothy, and the expectations between the two different cohorts are widely spreading at this point.
So let's take a look at this little screenshot that they put up, and we're gonna read that. Where we at? Right here we go. So, okay. First of all, the stock market moves on earnings of companies, and we're currently in the beginning stages of earnings season. So we just had some banks this week. They're talking about regional banks. There were some issues with the regional banks, which is why we've seen volatility this week, and some of the concerns and fears start to come about because balance sheets for some of the banks are not showing, positive results ultimately, right? So when you start to see banks and their balance sheets and some of the loans that they gave out and some of the issues that you're starting to see, those things then go into real estate and possibly, foreclosures. And then we start talking about a whole bunch of stuff like unemployment and, government shutdown. And it just creates a domino effect. And then we're going crazy because everyone's alarm bells. But what you need to understand is that the stock market will move on earnings. So if earnings for companies are good, then the market will do well. If the earnings show weakness, then you'll see weakness in the stock market. So number 2, it says, the second bullet says, not predicting a major pullback this earnings season. The reason is because the technology stocks, as well as other stocks, are doing really well. The GDP of the United States of America is growing at a positive rate, regardless of how you feel about the economy and your paycheck and your wallet. The GDP of the country is doing well. So if the GDP of the country is doing well, if earnings for businesses are doing well, and we don't see a crazy uptick with inflation, which they're not predicting, you're going to see the stock market do a positive over the next to end the year going into 2026. Right. And in that situation, when those things happen and drawdowns happen, if you look at the third bullet, it says retail investors continue to buy the dip. Retail investors are average people that buy stocks, just average people, right? Everyday people that buy stocks. That's retail investors, right? Institutions are big companies, institutions, banks, etc., hedge funds that have large amounts of money. We're talking about billions and in some cases trillions of dollars under assets being managed by professionals. So if you got millions and trillions and billions and trillions of dollars under management, then you do have to hedge for the possibility of a drawdown. Now understand, if I'm a professional and I'm managing $100 billion fund, and I put a lot of money into a sector or into the market in one, in a couple pots, right? If the stock market were to draw down, I would lose a lot of money at one time. Now, your $500 or your $100 that you lost in the stock market this week, or your, in some cases, thousands of dollars that you lost in the market this week, possibly ain't nothing compared to $1 million coming off the table in a day. Apparently last week there was a guy that lost $40 million in a day. Now we get into a whole different ball game. So when you are someone that is managing a lot of money, when it comes to an institution, you have to be mindful that there's a possibility of a downside, and then hedge your bets to ensure that if the downside does happen, you don't lose as much, right, as you would if you just, rocked out and bought everything. And even someone like myself that has, a good amount of money into the stock market right now, I hedge mine at times too. When I see that there are large drawdowns possibly happening, then I short a little bit to ensure that, we not getting trashed and killed when it comes to our portfolio. So when you are someone that is managing a ton of money, just always pay attention to that. You can hedge, you can do different things, and that's a little bit more of an advanced conversation when it comes to buying puts and shorting stocks and things like that. If you're a beginner in this conversation, don't do that. Buy for the long term. Just take advantage of those drawdowns when they come so that you can continue to build your account up over a long period of time.
Communication services, consumer discretionaries, the sectors where you tend to see the mega caps reside, showing that retail still believes that there's some more upside to this market. I don't believe it's a FOMO trade just yet, but I think it's getting to the area where it's a little bit frothy, and the expectations between the two different cohorts are widely spreading at this point.
Beyond tech, what other sectors stand out to you as far as retail interest or dislike?
Yeah, no, what I can tell you is that at least what we're seeing here at Schwab is there's been some inflows in the energy, communication services, discretionaries. Those are some where we're seeing some big inflows. Also seeing that on healthcare as well too. What we tend to see is some buying on the dips. Tesla, Amazon, those are stocks that, while they've had some run-ups, they've also kind of pulled back a little bit, and that's where we tend to see our clients buy. I know that our CEO Rick was talking about this a little bit earlier this morning. Selling on the rips, that tends to be kind of what that retail flow is right now, and so there is some trimming. You're actually seeing some money coming out of IT while we're at these highs.
All right, so I need full attention on this moment right here. When we talk, where we at? Come on, show the energy. The new play when it comes to artificial intelligence And what we need to be looking at is energy. We have talked about how data centers are being built. We talked about deals between Oracle, OpenAI. We talked about OpenAI and deals with NVIDIA, OpenAI and deals with AMD. We talked about a lot of deals over the last month between great infrastructure, artificial intelligence companies, software, application. All of these artificial intelligence companies are doing deals to build data centers and to build, these infrastructure facilities that's going to then power and provide, connectivity and everything to artificial intelligence, right? Texas, different places around the United States is getting all of these facilities built. What do facilities need? They need energy. They need power. They need electricity, right? If you're in a data center situation, you need cooling because the computers and everything has to be cooled, right? So if you know that compute requires energy, it requires memory, it requires electricity, natural gas, nuclear energy, right? There's a lot of needs when it comes to energy and artificial intelligence. It is time right now that we start paying attention to energy when it comes to AI. And the buy of the day is going to be later. We're going to have the AI opportunity, and I've been investing in it like crazy. Shout out to Troy over at Earn Your Leisure about putting this out there into the world when it comes to artificial intelligence and power and energy. And it's more than just one company, but energy is something that all of us need to, as investors, need to pay attention to. And there was a deal with a company that I know that's based in Pennsylvania that pays an amazing dividend and is also a company that's providing infrastructure, pipeline, everything across the United States to power data centers in Texas, and that just got a major deal to be the lone pipeline for Oracle. And we know that Oracle did a deal with OpenAI. So when we start putting these puzzles together and we say to ourselves, okay, what should we now be looking into when we are past the AI trade? We're not necessarily past it, but we are in a place where AMD didn't went up like crazy. Broadcom then went up like crazy. NVIDIA is still rising. Micron is rising, and TSM just did earnings a couple days ago and they're rising. All of these AI chip semiconductor companies have ran. So if you missed out on some of these runs, then hey, what do we do now? Invest in energy. I'm saying this now, right now, before we make the money, invest in AI infrastructure energy companies, because over the next 5 to 10 years, the build out of the United States, and as we are continuing to move forward, we have to understand that AI needs electricity, power, natural gas, nuclear energy, minerals, materials, and a whole bunch of other stuff. If you do the research and you start to take some time to understand, okay, this OpenAI deal with this company just did a deal with that company. Who is the partner with said company that's going to help electrify and provide energy and electricity to the data center? Who just got the deal? Who's connected to this person? It takes a little bit of research. It takes a little bit of time, but you can start to understand how all of these things correlate and what you should be invested in long term. So right now, sector seeing the most buying activity, that energy play, if you get it right, it can be something that can propel you when it comes to your portfolio and ultimately can make you a ton of money over a long period of time.
We were just talking about this a little bit earlier this morning, selling on the rips, that tends to be kind of what that retail flow is right now. And so there is some trimming. You're actually seeing some money coming out of IT while we're at these highs.
And we head into earnings season, so what Ultimately, do you think it's the setup in terms of that as we start to get the avalanche, so to speak, from many companies of their earnings?
Well, I think what's important about this earnings season in particular is it's the first one where we've actually seen in the last few quarters, we've actually seen analysts raise their estimates heading into the Q3 earnings cycle. So expectations are for about 9% year-over-year growth. We've actually beat that the last 2 quarters. But remember, this will be the first quarter where we actually start hearing a little bit more of the tariff talk, right? Because if you kind of look at where tariffs have really started to roll out, it really was in Q3. And so that's something I'll be paying attention to. The hard part is we're not getting a lot of that government data in advance of that, right? Whether it's retail sales, whether it's, employment, anything like that. So we're not seeing that. And I think that's causing a little bit of the skittishness in the market right now because they don't have that macro backdrop. So it's really going to be contingent upon a real strong earnings season to keep this rally going.
So that's a fact. That is an absolute fact. The government shutdown has caused uncertainty, not when it comes to the shutdown from the government, like specifically, it's the correlated effects. It's the fact that CPI reports, which is inflation, and PPI reports and jobs reports and all of these different things that the Federal Reserve uses to, forecast what's happening right now with the United States economy has not been reported because those things get reported by government programs, government agencies, right? So the government shutdown has caused uneasiness because we are not receiving the reports that we used to receive. So when you're not getting the information and you have to make an educated guess per se, then that's a little tricky because the Federal Reserve is looking to cut rates in 2 weeks, right? The next reserve meeting, I believe, is October the 28th. October the 29th, which is we're looking for another rate cut. The Federal Reserve takes in information on a weekly basis to make a decision on federal interest rates. We are preparing for another rate cut. We believe that we're going to receive one, but it is a little concerning due to the government shutdown that we have not been able to receive reports over the last, 2 to 3 weeks now, that we would have received if the government was open.
Joe, going to leave it there. Thank you. Appreciate it.
So, right now, the market is in a place of uneasiness, which has also caused uneasiness when it comes to crypto. So we're going to get on the crypto bag for a second. I think at one time, crypto was supposed to be a hedge. We looked at fiat currency. We looked at the dollar, the yen. We looked at the fiats, and we said digital currency is a hedge from fiat currency. So if fiat's having problems, then digital currency should do well. That's what Bitcoin was initially supposed to be. So every time we've had a huge drawdown in the stock market, Bitcoin and crypto has had a crazy run up, and vice versa, like a seesaw. But that's not what happened this week. The stock market fell and crypto fell at the same time. That's not normal. And the reason why a lot of this is happening now is because the institutions has now adopted crypto on their balance sheets. So at one time, crypto was not adopted by large scale companies, banks, hedge funds, etc. Now we have crypto ETFs. We have Jamie Dimon and Chase and JPMorgan saying that they're buying crypto, as well as the big banks and hedge funds and BlackRock and BlackRock created an ETF. Now Vanguard is going to create an ETF for Bitcoin. So now it's adopted across the board. So the problem here is Bitcoin a hedge? Is Bitcoin a hedge? Either way it go, we've seen Bitcoin come down significantly this week, and we are now going to have this report where we talk about Bitcoin and how it dropped tremendously, about close to 10%, if not a little bit more, in just a few hours.
Market that have been moving, including Bitcoin, which is above 105,000. You want to, and by the way, the related assets to the move are all down week to date. Riot, Coinbase, Robinhood, MicroStrategy. You've got Robinhood, obviously. What do you make of what's happening here? Is this just a de-risking move?
We were talking about shadow markets earlier, and if you want to talk about shadow markets, there's an incredible amount of leverage in cryptocurrency. And when Trump announced the tariffs again on China, I think it was October 10th and 11th, that you actually had the largest one-day auto liquidation in crypto is $19 billion. That's really, if you put a chart, I think the beginning of where you started to see unease. These auto liquidations just automatically occur at the different, we'll call them custodians. And so I do think this margin level, people have to watch that. You can find sites to see that, but to me that started it. So now you have to find a technical bottom. And I think just as momentum is starting to be questioned, Bitcoin's clearly going to be on the correlated side of lack of momentum.
All right, so we're looking at the chart and we see this Bitcoin chart, right? I believe the high for Bitcoin is 123,000. Give me 1 second. $126,000. 126,000 is the high for Bitcoin, right? We've seen it come down. If you look at the chart right there, right, it has come down. I remember I woke up, I believe it was this morning. This was early this morning, Friday, and I seen Bitcoin drop all the way down to 104,000, and I was like, "Oh my Lord, we need to buy more." See, when I wake up and I start to see huge dips, I look at it from an opportunity perspective only. I don't look at it from a fear perspective. It don't correlate in my mind that way. I said to myself, if Bitcoin got under 110, especially if it got into the 90s, I'm buying as much as I possibly can. And I'm gonna just be honest with y'all. I made a purchase of Bitcoin today at 105. Right. I said to myself, okay, look, I'm looking at the money, looking at how we can move money around. Where can we get some thousands of dollars from? Yes, I bought a few $1,000s of Bitcoin at 105. A few $1,000s worth of Bitcoin. I understand I don't got $106,000 just to be putting down on Bitcoin at the moment. I wish I did, but I don't. But we put a few $1,000s on Bitcoin today on the dip to 105. I wish I can get it at 104. I couldn't. It was before the market opened. I couldn't get there at that time. But 105, we got into it at 105. And currently at the moment, it is at 107. This is why it's important as investors that we take advantage of opportunities when they come. Sure, there will be another drawdown in Bitcoin. There will be. I was just having a conversation with a friend a couple of days ago about the possibility that Bitcoin will come down to the 80s or 90s at some point next year. And I said to him, listen, if Bitcoin hit 80,000, I would find every asset class that I have, and I would try to get some money to buy one Bitcoin. If Bitcoin were to come back down into the 80s, I mean 70s, my goodness, I'm buying a Bitcoin. Absolutely. Because we know Bitcoin to be something that from a long-term perspective, this is one of the best investments that you can have long-term. It is very much a risk, sure, absolutely. But long-term, from all that we have seen, we've seen adoption from companies, banks. And the one thing that you need to realize is when banks get involved, when hedge funds get involved, they're not putting millions and billions of dollars into an asset class that's not going to work out. Follow the money. It's not hard. If you see billions and you see a president that's invested over $800 million into Bitcoin, the president of our country, the United States of America, Donald Trump, has invested over $80 million into Bitcoin. What more do you need to see for you to invest in Bitcoin? And I'm not saying investing in crypto as a whole, but what more do you need to see? If you got BlackRock, the biggest asset manager in the world, look it up. Trillions of dollars under asset management. If you got Vanguard, if you have our president, if you have banks, JPMorgan and Chase, if you got, whoever at the billionaire level that's telling you, hey, listen, we put our money into this asset class, and we believe in it, and now we're going to then adopt it, and then we're going to put policy towards it when it comes to this country, right? And I believe the Genius Act by the United States and by our president. What more do you need to see when it comes to crypto and specifically Bitcoin? There's nothing else that need to be said. So from my standpoint, opportunities present themselves, as Troy would say, fire. You gotta execute at the highest level. There's nothing else that we need to talk about. Execute at the highest level. When you see great companies like Nvidia come down in the 70s, man, I seen Nvidia jump down as 170. I believe it was 177 a few days ago. I said, okay. Sure. Would we love it at 160 something? Sure, we would. But I might not ever see it at 170 again. At least not right now. So you know what? I'm gonna buy a 9-month out option, a 200 strike price. And I bought Nvidia at 177 for August of 2026 for a 200 strike price just a few days ago. When the opportunities come, you take advantage of those opportunities. You know what Nvidia's share price is right now? 183. I'm up already over 30% on that trade. When you see the opportunity come, take advantage of the opportunity. So, as I said, this morning when I woke up, Bitcoin was 104. I said, okay, I need to figure out how I can move some money around to ensure that I can invest some money into Bitcoin. And we invested a few thousands of dollars into Bitcoin today at 105.
You just stay with what you have?
Yeah,
no moves, whether it's the IBIT, Grayscale,
well, with
Bitmine.
Yeah, well, BM&R, I love selling calls against that. There's so much volatility. And so I think if you don't have calls, you can still get 10% call premium for selling like 10% out of the money calls on Bitmine. So that's the way I'm going to play that and just get that income while the asset class continues to be volatile.
Why? So I assume you're sticking around or what?
I'm sticking around. Look, it's not a big position at all, and it's smaller now than it was a couple of weeks ago. But what you say underscores it. And look, I still don't know what the use case is, but I own it because I still think there's momentum that's going to come into it over time. President Trump, it's a large part of his net worth. So I'm hanging.
What did he just say? I just said this. I literally just said this. He said, listen, I don't understand it. I don't know too much about it. What I do know is his policy towards it. He said the president of the United States owns it at $800 million. It ain't nothing else that need to be talked about. It ain't nothing else that need to be said. This gentleman is a Wall Street analyst for a huge major hedge fund. He said I don't know what it is. It don't matter. A president of the United States owns it, $800 million worth of it, and a country is putting Genius Acts and policy towards it. Big hedge funds is buying it. That's all I need to know to buy it myself. I just said that. So if you are someone that's right now sitting on the sideline and saying, I mean, Bitcoin risky, it came back down to 20,000 and, it was up to, 70,000, came back down to 20. And then it rose up to now it went up to 126 and now it came back down to 104. I don't know if I want to, invest in it. Okay. Just don't be mad And don't be a victim in 10 years when Bitcoin is at $500,000 and you're like, oh my Lord, I should have at least put some money towards it. Or as a parent like me that has children, I look at the fact that, hey, this might just be for my children. This might not necessarily be for me per se, but putting a little bit of money towards this digital asset class may ensure that my children, my son, my daughter, and my children ultimately in the end have this digital asset for themselves that's going to then grow to be something amazing ultimately in the future. Understand, as a parent, it might not necessarily be beneficial for you only. It might be just beneficial for your children. You might just be investing for your kids, right? I just put another few $100s in the account for the custodial account for baby girl. Her account is growing, and it's amazing to see. And today, I believe we bought $200 more of what I do. I think I did the AI infrastructure energy play. Yep. We building up her dividends. We building up her account. Over the next 18 to 20 years, that account is going to just grow and grow and grow. We just continue to invest money in this in this channel, in this family, and ultimately in my life. That's the only thing I care about, and that's the only thing I do. The focus is investing, right? The focus is long term. We're going to continue to put money towards things that's ultimately going to benefit us long term. So today is an opportunity, and even right now, it's still an opportunity. Bitcoin is at 107. If you're sitting right now, you're looking at it, and you taking an opportunity to take a chance. Hey, Bitcoin at 107 is not bad. It's not a bad look. Not bad at all. It's opportunity. When you see Bitcoin at 150 in 6 months, and then you're mad because you ain't putting no money towards it. Hey, 107, put $20 in it right now. 25, 50, whatever you got. Put something in there and allow that money to start to grow. Obviously, with Bitcoin, you don't need a whole $107,000 to invest in it. You can buy partial shares just by opening up a crypto account and, start investing in crypto. All right. So last but not least, we're going to take a look at AI, and we're going to look at the new AI play. One of those plays for the next year, in year to 5 years. If you start investing right now in artificial intelligence and specifically infrastructure into artificial intelligence, and what I mean by infrastructure into artificial intelligence, I'm talking about energy, electricity, power, cooling, natural gas, nuclear energy, etc. Right now, we have an opportunity to invest into the build out of infrastructure, data centers, and energy into artificial intelligence. Let's look at that.
My pick is Vertiv. It is a data center build out play. CapEx is expected to grow about 50% between 2025 and 2029. And in that kind of a backdrop, this company is able to probably put up a 15 to 20% organic growth. They have a backlog of $8.5 billion. Their book to bill is running at 1.2 times. And they've had record orders of $3.2 billion, which rose 25% year over year last quarter. And what I think is the real story is not only is it the growth, but I think eventually the operating margins, they're troughing right now. And I think they can accelerate from this quarter going forward. And their target is to get to 25% by 2028. So if you add it all up, Frank, and I think you can see something like $7 to $10 in earnings power.
All right. Steph, you and I, we've actually talked about this company a couple of times. One other time on the halftime report, you've been bullish on it for a while. One question I have for you is valuation. When you look at some of its other peers in the space, you look at Johnson Controls and Eaton, they trade at a significant discount to Vertiv. Why not go with one of those names that offer similar things at a much lower valuation?
Well, I also own Eaton and I also own Quanta Services, so I definitely have exposure to this theme. But I think Vertiv actually has the fastest growth. And as I mentioned, the margins are so depressed. So if you can get this great growth of 15 to 20%, I think I'm being conservative, by the way, on the organic growth. If you can get that and you can get margin expansion, I think that they have much more operating leverage. Not to say that the others don't, but I think this one, they have more upside and better, and just overall better growth.
See, mucus, my mic was muted. So let's go back to initially what I was saying. So Vertiv is a company that provides mission critical digital infrastructure technologies and lifecycle services primarily for data centers, communication networks, and commercial and industrial environments, right? So Vertiv directly works with companies that ultimately are building out data centers. So when we talk about artificial intelligence, the data centers need infrastructure, right? Need energy, electricity, cooling, etc. Right? What Vertiv provides is liquid cooling technology, right? It says as part of this collaboration, Vertiv supplies high density liquid cooling solutions, including coolant distribution units and in-rack power to manage the extreme heat generated by NVIDIA's powerful AI GPUs. Okay. So if you have a company of the level of NVIDIA, which I call is the best company in the world, and they are providing GPUs to everybody, all of the major scalers, all of them in Meta, Microsoft, everybody buying from NVIDIA, right? Over the last 3-4 years, right? GPUs, right? Then they're building out data centers all across the United States. And we are continuing to build and build and build deals upon deals upon deals. All of these GPUs, all of these data centers needs cooling technology. So it's not just this company, but there are other companies that are providing electricity, infrastructure, pipeline, and that's another company, pipelines for natural gas and cooling to data centers that's going to be that will assist artificial intelligence and data centers and infrastructure over the next 20 years. This is not something that's going to just now hit and is going to, die in 2-3 years. No, this is something, it takes 5 years just to build out a data center. So if we understand that there are these mega deals between OpenAI and NVIDIA and Oracle and all of these big players and companies, and they need electricity, infrastructure, cooling, natural gas, everything to power these facilities, it's only smart to look at it and say, okay, well, let me invest in the benefactor of artificial intelligence. Because chips at some point, semiconductors will not run out, but they're not going to need as much as they need now because they're building it now. So if I need, 100 million GPUs in 5 years, I'm no longer going to need 100 million GPUs. I already built out my team. We good. I pick my players, right? Now I need to build out and ensure that my players is working properly. So this company, Vertiv, is one of those companies. I've already invested. We already bought stocks. We did this months ago, right? And we're starting to build out a new pipeline infrastructure, natural gas play right now, right? So take a look at AI infrastructure. Look at the deals that have been made. Take a look at the companies that have done the deals. Look at what is needed to power these facilities, and do the research and find the company that's ultimately going to benefit you long term. This company was just on CNBC and she's talking about it, and I'm just looking at it like, oh yeah, I should definitely put this out there because this is already something that we've been talking about with the earners and Earning Leisure. Earning Leisure popped this out thanks to Troy and Rashad and Ian Dunlap at EYL. Put this out there for people that's a part of their family and everything. Shout out to EYL, right? But now it's mainstream, and now they talking about on CNBC. It's time. It ain't over. It's time. We still in the beginning stages of AI infrastructure. Invest in AI infrastructure and infrastructure. Just like in the dot-com bubble, there were companies that came about after the bubble hit that ultimately led the future. I'm not saying Vertiv is one of those companies. What I am saying is they're going to highly significantly benefit from the AI infrastructure and the deals and the data centers and the facilities that need cooling. And they need their technology ultimately. They already have the partnerships and the deals currently with NVIDIA. And if you are a partner of one of the best companies in the world, it's an easy answer. We invest in.
Right.
Plus, not only that, best in class management.
You know, I was just going to come to that point. So that's one of the points that makes you really like this company. I've had the pleasure to meet both the executive chairman, David Cote, who's formerly the Honeywell CEO. So obviously a lot of connections when it comes to tech, industrials, et cetera, and also their CEO. I had a chance to interview him as well. Any concerns about the fact that David Cote has his fingers in quite a few pots? He's actually the executive chairman of another company that just went public that does metal credit cards. And also, when you have the kind of success this company has, often other companies start looking to poach your executives. Any concerns that this success, they might be victims of it themselves, the company, I should say, where their executives may be pulled in other directions?
Well, Dave Cote, I think he can do a lot of different things. He's an exceptional manager. He was an exceptional CEO at Honeywell for over a dozen years. And look what that stock did under his reign. So to me, as long as he's there, I think, it's very positive. If he's not there, they have a very, very strong bench. They have a new CFO also with a proven track record to focus on margins and productivity. So I think they'll be just fine. But I don't see Dave Cote going anywhere anytime soon.
One other question. This stock's become heavily levered to the AI trade. If that cools down in any way, is that also a risk for this company, or do they have other lines of business that can also move the stock higher?
No, I mean, this one will trade exactly with the AI data center story. But I do think that I don't think we're in a bubble in AI. Data centers, we don't have enough of them. We have 11,400 data centers in the world. The U.S. has 5,400. We're at 45% of the data centers. You've got to get that to 30,000 easily to meet all of this demand. But to your point, if the AI trade cools, this one will as well. I just don't see the AI trade cooling.
Oh my Lord. So, okay. Okay. I'm a math guy. I love math. It is something I enjoyed my whole life. This is also the reason why I love investing, because it has a lot to do with numbers, and I love numbers, right? So it's something that it runs in my brain at 100%, right? 100 miles an hour. If we're at 40% data center demand, okay, stay with me. It's a math problem, but it's statistics at the same time, right? If you were at 40%, if you look at a pie and you look at it and we're at 40%, we're below half. And you telling me that we have to build out the other 50, or so we're at 40%, the other 60%, right? We're not gonna go to 43%, as she said, but let's say we're at 40%, we got to build out the other 60. The company that we are talking about right now benefits from every percent that goes up and more data centers that get built out, because the technology that they provide then assists with the cooling in the data centers. How much more money can the business make if we get another 60% to get us online at 100, or even let's just say another 50% to put us at 80% from a demand standpoint when it comes to the United States. How much more money, how much more revenue, how much more profits would a company make if they build it out at another 50% to put us at well, I'm sorry, put us at 100%. You got to get over 100% to get to 100, but to put us at 80%, you got to put us at you got to put 100% more out there. Since you're at 40 right now, how much more money would that company make? So from a basic math and statistics perspective, you can make an educated guess and say that Vertiv and other infrastructure, energy, electricity plays that it comes with artificial intelligence and data centers will make a lot of money over the next 2 to 3 to 5 years easily. So it would behoove you, as we say in the military, to take a look at not just chips and semiconductors when it comes to AI, but also take a look at the infrastructure and the build out and the data centers and the connectivity and the cooling within that connectivity and everything else that comes with it, memory, everything, and what companies ultimately benefit and will benefit over the long term in the industry in the technology that we call artificial intelligence. That is how you can possibly make a lot of money, by investing your money into great companies that are the top in their sector. And by the way, Vertiv, VRT is the ticker, is the top cooling technology energy company from a data center perspective in the United States. So we're not scraping from the bottom of the barrel. We still investing in an amazing, great company that's the best in their industry, and it's not close. So as I always tell y'all, invest in the best companies in the world. Invest in the best companies in their sector. Do not scrape from the bottom of the barrel. Invest in the best companies, and you will do well in the market as long as you buy at the right prices. All right. So moving forward into next week, we have earnings next week. And I'm gonna just put out a few companies that we have earnings with. Right. So on Tuesday, October the 21st, Netflix will be reporting. We have Coca-Cola that's reporting. See if we got any companies. Lockheed Martin is reporting on Tuesday. All right, so moving on to Wednesday, October the 22nd. We have Tesla, big earnings for Tesla. If you are investing in Tesla, it's something that you want to pay attention to. For earnings for Tesla, you want to look at the deliveries for the quarter. You also want to look at the forecast for deliveries, but more importantly than anything else with Tesla, it is the auto taxi technology and the build out for that in Texas, and what Elon is going to say when it comes to that expanding in the next quarter and in 2026, right? So Tesla stock will run based on those forecasts. It's not going to necessarily be about earnings per se, but it's going to be based on the forecast of the auto taxi technology and their projection moving forward. Also on Wednesday, Vertiv, we just talked about it, VRT. Vertiv will be doing earnings. Again, Vertiv stock is going to run based on their earnings as well as their profits, and ultimately, again, their forecast, what they've seen in the build out of their business over the next couple quarters, right? So their stock will run up or down based on their forecast also. So that is Wednesday. Let's go to Thursday. All right, so Thursday, October the 23rd, we have T-Mobile, Intel, Ford. If you are into some of the autos, Ford will be reporting. All right, so Thursday is a few of those companies, and then Friday, October the 24th, we have P&G, We have Bank of America. That's an important one when it comes to the banks, national banks. Anybody else I see that steps to my mind? Nope. All right. So we got a few different earnings coming up next week. If you are investing in some of those companies that I just talked about, very much be aware of the company that you are investing in when it comes to their earnings. Don't necessarily worry about the ups and downs of the stock. You really just want to pay attention to the company, if they're doing well, the forecast, as well as their current beat or the current miss when it comes to their earning expectations, right? So, as I stated, a couple of days ago when we did the beginner's guide to investing, the 5 tips, I think tip number 4 or 3 or 4 was you have to learn and understand the business that you're investing in. All times you have to understand the business that you're investing in, why they are successful, what possibly could hurt the company, and ultimately where they're going to continue to forecast in the near future, right? It's always important for you to know the business that you're investing in and know the investment that you are investing in. All right. So today we had a discussion on market volatility, how we need to be looking at market volatility, how we should be buying into volatility, right? When opportunities come, you take advantage of those opportunities. You buy great stocks at great discounted prices. We talked about Bitcoin and how Bitcoin came down today to 104 and how I put some money into it, right? We talked about always taking, again, another opportunity when Bitcoin drops to come down, you take advantage of that. We also talked about AI infrastructure and some of the companies, specifically Vertiv, that will benefit long-term about data centers, cooling data centers. We also talked about the possibility of you taking a look at and doing some, research on electricity, natural gas, pipeline build outs for artificial intelligence and data center facilities. I'm giving you game on some real high level information. Again, I'm gonna say it again. Do some research on the businesses that's doing deals, right? We talked about Oracle, we talked about OpenAI, we talked about Nvidia, we talked about SoftBank, we know AMD, we got so many companies that's doing deals, Broadcom, etc. Right? Look at who they're doing business with, who they're partnering with. What does those infrastructure and what does those facilities need to power those, data centers? All the information is out there, right? You got AI, ChatGPT, and Grok X, and Claude, and Copilot, and so many ways that you can do research, right? Prompt the AI to tell you exactly who is doing the deals with X, Y, and Z, who's going to benefit, who's providing electricity, who's providing natural gas, who's building out the pipeline that's then powering OpenAI facility and Oracle's deal out in Texas. I just gave you a whole prompt. It's no excuse. All right. Do the research, find the great companies that you love, invest in those companies, make money. And as I always say, invest, invest, invest. Invest, man. I love y'all. I appreciate y'all. I'm out. Stock Market Live. Again, we are back next Friday. We're going to continue to pour into you when it comes to stock market next week. If you love and appreciate the market and ultimately this channel, I just suggest that you like the video. Please like the video. Hit the like button. Subscribe to the channel. Follow me on YouTube. Follow me. Subscribe on YouTube. Follow me on Instagram. Follow me on Facebook. Let's continue to pour this thing into you. Let's continue to progress in the channel ultimately long term. I love you guys. I appreciate y'all. I'm out. Antwaiyn Smalls, Financial Blueprint. Peace.